Okay. Okay, so this week we're going to be focusing on strategic planning. It's part one because it's a little extensive. So I wanted to split this up into 2 weeks just to kind of ease everyone into the material, and then spend some time on financial statement review so that everybody is all caught up on financial statements and other basic concepts that you'll need for the math that we'll do towards the end of this program. So it's going to be part one. Part two is going to be a little bit shorter. That'll be next week. Part one, we're just going to delve into strategic planning for FP&A. So let's go over financial statements really quickly first. So financial statements. These are the bedrock of kind of reporting a firm's current financial status, as well as all of its assets and liabilities, everything that it essentially owns. That's on the balance sheet. I'm actually going to start off with the income statement. So the income statement captures an end-of-year view of the previous fiscal year activity. So, for example, if I want to see how a firm did throughout 2020, I would be looking at a year-end 2020 income statement. We're going to be kind of looking over what kind of stuff is in there, how it's itemized, but generally it starts off with revenues, or the dollar amount of all the goods and services that you sold within a year. Now, this is cumulative. This takes into consideration the entire year. Now, for a company, this time span can differ. So for most companies, the beginning of the year is January 1st, and then you report it by the last day of December. There are some companies whose quarters are a little bit different. Maybe for them, the accounting period begins March and ends the next year, March. So they report it then. But usually it's late December when the income statement numbers are finalized, same as the statement of cash. So that's cumulative. And I'll go into all of this stuff: revenues, cost of goods sold, which is what COGS is, which is how much did it cost to manufacture all the stuff that you sold, your inventory, basically. Then your SG&A, those are sales, general, and other costs, and administrative. So that can be payroll or supplies, other day-to-day overhead operational costs, maybe the machine that goes into making the products, the utility bills and the electricity and rent for your storage units and factories that you may have open. That's your day-to-day costs. So it's all short-term and variable. Long-term we'll get into with the balance sheet. Interest expense, that's how much interest you're paying either semi-annually or annually as a result of how much debt you have. When you have debt, when you take out a loan or something, you have to pay interest on it. So that interest payment goes into the income statement because you have to pay that immediately. Taxes, that's once you calculate your operating income after you take away the COGS and SG&A and all that, and you're at the point where you can calculate your operating income. Then you further deduct taxes, and there are a few more stuff like amortization and other costs that are also in an income statement. The balance sheet isn't exactly a cumulative thing, a cumulative statement. It takes into account a company's assets, liabilities, and stockholders' equity. So when I mean it's not cumulative, I mean that it's different from the income statement and the statement of cash flows in that it's a snapshot. So by snapshot, I mean when you look into a company's financial situation at any given point in time, it could be a completely random point in time, like, I don't know, July 27th of 2021, let's say. On that particular day, what does the company's financial health look like? So what are its assets? What are its liabilities and stockholders' equity? The way I like to think of it as is your assets, or a company's assets, is all the stuff that a company owns, or all the stuff that a company has access to. Now, this could be cash. This is just listed as cash within your assets. It could be accounts receivable, which is money that you don't yet have, but you are entitled to. That's money that your customers are going to have to pay back to you, or maybe even your, if you're a supplier of something, then your customers in that area will also have to pay back to you soon. And then your liabilities and stockholders' equity is how you finance those assets. So your assets is the stuff you have, and then your liabilities and stockholders' equity is, okay, who has a claim on these assets? So who has the legal right to claim these assets, essentially? Liabilities is all the stuff that you owe, essentially. It's all your debts. It's your accounts payable, which is your short-term debt. It's your long-term debt. And it's anything that finances your assets that is a liability, that is not equity. So it's stuff that you usually have to pay interest on. And then finally, stockholders' equity is the equity portion of the right-hand side of the balance sheet. Look, the left-hand side is the assets, and then the right-hand side is liabilities and stockholders' equity. So essentially, stockholders' equity is whatever your equity holders or your shareholders, if you are a public company or you issued share, that's what your stockholders' equity, what they have access to. Stockholders' equity generally consists of common stock, some preferred stock, if you want to issue preferred stock, and retained earnings. And retained earnings is basically whatever money you have left at any given point in time after a year that you didn't pay out in dividends. So if I have a net income of $100 at the end of 2020, and I decide to pay $80 out in dividends to the stockholders of the company, my retained earnings is $20. So that's different from net income. Net income is essentially your EBITDA. That is all the money that I have left over after I pay for the cost of goods sold, after I pay the SG&A, I pay my workers, I pay my rent, my utilities, and I pay taxes, decrease depreciation and amortization, and what I'm left with is net income. Then you would subtract dividends, and that's how you get retained earnings. That's a big part of stockholders' equity. And retained earnings is the connection between income statement and balance sheet. We're going to see that a little bit later. Basically, you calculate your retained earnings on a year-to-year basis, if you have any, from the income statement. And whatever is left, it just gets added back to the balance sheet as retained earnings or accumulated retained earnings. And you can convert that to cash or any other asset, because that's the money that you have left over at any given year. So yeah, the balance sheet, I think I went on that topic a little bit too long, but I definitely want to hammer in these points because I think these are the most important points to know from this entire slide deck. The rest is more theoretical, but these financial statements are very important. I was just pulling up some more examples of company liabilities as well. Bank debt, mortgage debt, wages and taxes owed. These are all forms of liabilities. Whatever you owe, usually this will be in accounts payable, as well as long-term debt. That could be notes or long-term bank debt for financing. Anything like that goes into liabilities. And finally, the statement of cash flows. This is something that not a lot of people really touch on that much. I'm sure most of you have heard of income statement and balance sheet. There are many people that are like getting into finance as freshmen that have never really heard of a statement of cash flows. So a statement of cash flows, it provides an overview of a company's cash position and how liquid they are. So essentially how much cash you have. And the biggest takeaway with the statement of cash flows is that it provides investors and the company a snapshot, well, sorry, not a snapshot, but a view on a year-to-year basis of how liquid the company is. If a company needs cash at any given point in time, how easily can the company access that cash? This is not the same thing as net income, because net income is just a part of cash flows. It's one part. It's known as an operating activity, or it's a cash flow from operating activity, but I'll get into that later. It's a small part. Net income is how much you make after paying taxes, depreciation, amortization, after you pay off all your suppliers and all that. It's what you're left with after a year of operation. But a statement of cash flows, it can also come from other sources. It could come from investments. So if you buy a plant or other property or equipment for long-term use, that's a deduction in the cash flow. So whatever you added back in net income, you would deduct in PP&E, like I just mentioned. That's investing. Finance, if you issue debt, you would take that into consideration when looking at your cash flow. If you issue debt, that's usually an increase in financing cash flow because you're issuing debt and you're getting cash in the short run. Now you have to pay interest on that debt, but in the short run, you're getting money. We'll get into like the adding and subtracting in the later couple of slides, because we're going to revisit these financial statements at the very end of the slide deck. In the middle, we're going to go over some basic strategic planning stuff. But if you guys have any questions about any of the financial statements, just let me know. In my opinion, I would say the statement of cash flows is the most important, because without cash, a company can go under really quickly. Now, there are periods of time where a company's balance sheet is, it doesn't look good. It obviously varies from company to company and industry to industry. But generally speaking, having too much debt is bad. There are some companies that have too much debt, but through refinancing and through kind of using retained earnings and using accounts receivable and other assets in order to slowly pay off those liabilities and convert more to equity, a company can fix its balance sheet. A company may have down years where it has a negative net income or a low net income, especially growth companies like Tesla. It had extremely negative net incomes. It was losing millions of dollars a couple of years ago, and it just broke even. There are tech companies that are still unable to break even after decades of operation. But that's not an overall indication of how well the firm is doing, quite as much as its cash flows, how much cash it has access to. If a competitor were to come into your space tomorrow, would you be able to get access to your cash and use it for whatever purpose you deem necessary? That's where cash flows come in. And that's why, in my opinion, it's the most important. And if there's one equation I want you all to take away from this slide, is A equals L plus SE. And I went over this a little bit before. A is assets. It's always equal to liabilities plus stockholders' equity, or just equity. It's pretty much the same thing. Because you may not always have stockholders. Companies aren't always public. They don't issue stock. It could just be equity. It could just be a partner or a person on the board who paid an X amount of money in order to gain a certain percentage of the business. That's not stock, but that is equity within the company. That's what I mean by it. And your liabilities plus equity is always going to equal your assets, because your liabilities and your equity are the two things that finance your assets. Your assets are either owned by you and your partners, equity, or you borrowed money in order to finance those assets. That's where liabilities come from. So A is the stuff you have, and L and SE are the stuff that you paid with, essentially, in order to get those assets. All right, I think I spent a lot of time on this one, so we're going to move on. So here's some strategic planning basics. For FP&A, strategic planning is very broad, but essentially strategic planning is just a combination of two activities. And it's right there in front. It's always been right there in front. The title of this track is FP&A, financial planning and analysis. So the two ways that this track is split up is financial planning and then analysis. I like to also kind of make it a little easier to understand by saying forecasting and scenario planning. Analysis is more the forecasting aspect, and then financial planning is more scenario and capital budget planning. And those are the two main aspects of how FP&A is split up. Now, it's also important to set up both financial and non-financial goals right off the bat before crunching any numbers, in order to help management and financial planners, like the people working in FP&A, the people crunching the numbers, to both get on the same page. Are they working together in a manner where they understand the firm's overall goals? Are they achievable? What's the timeline of the objectives, and what are the milestones that need to be achieved? These are all the the goals within the FP&A track. Last week I talked about the different jobs within FP&A. One of them is reporting, and reporting really comes in handy when talking about the third topic. So scorecards and other technical materials are needed to monitor strategic progress. So it's not enough to just, come up with goals and work on them. It's also important to report those goals to your superiors, to your coworkers, to other members of your team, in order to be like, okay, we're all on the same page. We're all headed towards and focused on the same goals, and we're headed in the right direction based on the timeline that we've created for ourselves. So that's where scorecards and other reporting metrics come in handy. Automation is extremely important, especially in today's world, because you don't want to go through like an Excel sheet row by row in order to try and make changes, or in order to try and analyze it. And when you do have a process in order to analyze a certain type of data, because you'll see that data in FP&A and finance in general can be pretty repetitive. Since it's repetitive, you are almost expected, especially in the technology era, to be able to reproduce the task that you do. So if I want to analyze an income statement and come up with the ratios, and I do it once, either through a macro or I do it through manual calculations the first time, I should be able to reproduce that. So that the next time I get an income statement for the same company or a different company, unless it's like very different and they have like different stuff, but generally that shouldn't be the case, I should be able to reproduce it so that the next time I do it, it takes me half the time. Then the next time it takes me a quarter of the time or an eighth of the time, to a point where it's instantaneous. I get data and I get the output that I need immediately. And it's on a curve usually. So it's basically a learning curve. The first time you do it, since you're creating the program, it takes a lot of time. And then the more you do it, the less time it takes, to the point where it's fully automated and it's ideally instantaneous. That's why automation is so important for financial analysis, because you don't want to focus on calculating the numbers for FP&A. You want to focus on analyzing what those numbers actually mean. Because anyone can calculate numbers. We've been doing arithmetic and math since like kindergarten. It's a matter of analyzing those numbers and figuring out what's wrong with the business. How can certain measures be improved? Why are certain margins super low? For instance, are we handling and managing the balance sheet well and not just pursuing net income because we won't have cash soon? And we can come up with these questions before we come up with solutions by looking at data. That data should be automated as much as possible. And finally, dashboards for reporting, data viz tools in order to elucidate trends and patterns within a firm's financials, much better for people to see rather than just an Excel table of numbers. That's important. It's very important to get into data viz as early as possible, because it will make information that might take weeks to digest. You take one look at it and understand what's going on. Process charts like Gantt charts and other charts in order to clearly plan out objectives is another basic of strategic planning. I think that applies to every track, not just FP&A. Just how can we organize our tasks in a way that we're getting them done on time, and we can hold each other accountable that we're getting them done on time. Visualize strategy and objectives, and reasoning and progress. Yeah, progress was the word I was looking for, but it's right there. Perfect. That's pretty much what I want to get to for this slide. So some core competencies. Now, the first thing, obviously, that I have, the first bullet point, clear understanding of financial terminology found commonly within income statements and other important documents. So when someone's saying COGS, you should know right off the gate, right out of the gate, cost of goods sold. When you hear SG&A, I know I kind of tripped up on this a little bit, but selling, general, and administrative expenses. That's your overhead, basically. So when you hear these abbreviations, these acronyms, you should be able to understand what they are, because they're so commonly found within financial statements and other aspects of business and finance. Some documents that you should definitely understand, how they look, what type of data is on them. 10Ks, which is your annual report for a company. A 10Q is your quarterly report. Usually it has the same statements, but it's for a quarter as opposed to a year, which is in your 10Q, and your financial statements within the 10K and the 10Q and other filed documents within the SEC. Pretty much all company documents like the 10K and the 10Q are either found in the investor relations page of a company website, or it's all found on the SEC website. If you just look up a company, you'll be able to find their financial statements if they are a public company. Now, even if they're not, I feel like you should be able to pinpoint those statements. Okay. Be able to utilize technology for calculation purposes. Technology, as I said, super important. It's also important to automate those functions. Excel is the most commonly used one because it's just so versatile. And like, of course, I know a lot of you, and I did this myself, but many people in college, many students, they tend to say that they're, very proficient in or extremely advanced in Excel, but it's such a vast technology, and there's new stuff coming out within Excel every single day that you can't really say you're an expert to the extent that you need to be for FP&A. For automation, you need to know macros. You need to have a basic understanding of VBA, even if you don't understand how to, each and everything about the VBA code, because it can get a little cumbersome from time to time. It's important to understand how Excel can be leveraged in order to create and automate processes within FP&A and finance. Obviously, there are other technologies as well for data viz. There's Tableau. I'll get into that a little bit later. There's also Power BI, SQL for data querying. But for analysis, Excel is a great place to start. And other forms of technology that will come later in order for financial analysis and calculations are also very important. You also need to be able to capture future market trends and demand fluctuations in order to hedge against or reduce the risk that your company will have. You always want to be watching the news and seeing what's going on. I know it's pretty busy now with the Russia-Ukraine stuff, but just generally speaking, you need to understand what's going on around the world that might impact my company's operations, whether it be domestic or international. What is the Fed doing? Are they buying or selling bonds? Are they raising or lowering rates? What are they intending on doing? And how will it impact my future cash flows? What is the demand for this product going to look like? What is my competitor outlook? Am I going to lose market share fast because of, the nature of the market that I'm in, of the industry or sector that I'm in? You have to take all of this into account, come up with the different scenarios in order to financially model them and make yourself ready and make sure that your firm is ready to face any difficulties or dangers or threats in the future. And finally, and I talked about some of these skills a little bit vaguely, but I'll put a name to them. Hone in on capabilities in qualitative and quantitative analysis. So I talked about threats, opportunities, strengths, weaknesses before. That's where you have your first, and I believe the most important, qualitative analysis metric, which is SWOT analysis: strength, weakness, opportunity, threat. This can be within your industry. This can be within the world. It's very adaptable. But the more detailed that is, the better understanding you have about your firm's financial and managerial goals. But for our purposes, mainly financial. Business environment analysis, that takes into account a bunch of different factors. That's your internal environment, legal, economic, political, administrative, your suppliers, all of that, the relationships that you have with your suppliers among the business value chain. That's business environment analysis. Business life cycle planning. So what stage of the business life cycle is your business in? Is it in the growth period? Is it in the startup period? Is it in the maturity or the decline period? And if it's in the maturity period, how do you extend that maturity so that the company doesn't decline anytime soon? That is a big part of financial planning for a lot of big companies usually, because they don't want some small company coming into their market and stealing all of their market share. Microsoft doesn't want that. Apple, Amazon, Coca-Cola, these companies don't want that. They're in the maturity phase. And in many cases, such as Coca-Cola, they've been in the maturity phase for probably a century now. And they just continue to expand it through strategic motives and strategic planning. And a lot of that is financial. Now getting into the quantitative, I went over some of this before. Pro forma financial analysis, this is usually forecasting your cash flows and income and your balance sheet state. Is your balance sheet going to be able to support the level of growth that your company is undergoing? What is the level of growth that your company is projected to go through in the upcoming years? All that kind of stuff falls within pro forma analysis. Financial statement analysis, this is just ratios. We're going to go over a lot of these towards the end of this track. And it's just what kinds of conclusions can you draw from the financial statement? And then industry and sector comparisons. I think that kind of goes hand in hand with financial statement analysis. So the numbers that you have, in and of itself, it depends. It's kind of meaningless, to be honest, unless, of course, it's a super high or super low number that is completely out of the ordinary that you've never seen before. Usually it depends. You have to compare it to the past performance of a company or to other companies within your industry or sector. That could be your gross margins. How much is your gross margin? How much is your contribution margin, your earnings per share, your PE ratio within your industry or sector? What's your operating income margin? All that kind of stuff. So whatever you come up with in your financial statement analysis, it's important to put it into context through the lens of past performance and other firms within your industry or sector. In terms of pre-planning, this goes back to what you should do before you even crunch the numbers. So establish communication guidelines and rules within a team. You almost always have to work with teams in FP&A. There are very few people that operate alone because the risk of human error is very high when you operate. That's why companies are going to put you in teams, and it's very important that you establish communication within your team. Otherwise, it's going to go haywire. You have to be able to work well with each other. And then and only then can FP&A work truly begin. Standardize and automate processes and analysis as much as possible so that you don't have to, reinvent the wheel every time you go in for work or you're assigned a new project. You already know the basics, and you should, at a certain point, automate processes to the point where about 40 to 50, maybe even 60 to 70% of all of your processes should be automated and should be done very, very quickly. Now, how quickly, that depends. Some processes can realistically only be done in like hours, and others can take seconds or minutes, like running a macro. But hours, it could be, compiling an entire report could take hours, and it can't be cut down unless you have a better laptop or something like that. But automate those as much as possible, and whatever's left that actually takes time, that's the analysis part. That is where the human instinct and intuition comes in. So shortening those cycles of work is very important. That's why standardization and automation is so important within FP&A. Clearly outline the technologies and systems to consistently use for projects. By both technical and ad hoc and human-made. Human-made, I'm mainly referring to like macros and other technologies that are project-specific. Technical, I'm mainly talking about Excel or other types of technologies. Now, in a team, and the next bullet point will kind of get into this a little bit as well. It's important to have people that are proficient or specialized in different technologies usually, because you don't want an entire team to just all be Excel, Excel specific people or Excel whizzes. You want one person to be good with SQL, or one person to be good with data viz through Tableau or Alteryx or Power BI. You want another person to be good at programming, maybe Python or R, in order to come to some conclusions. Obviously, you should have a base level understanding of certain technologies. Really, Excel is the main one that I can think of. So some to use commonly, but they should also be specialized in different technologies so that you have a team with a diverse array of skill sets. And that's what makes for the strongest team. It could be difficult at first, but in the long run, it's always better. It's almost always better than everybody being good at the same thing, because that limits your ceiling as to how well you can perform analysis and planning within the firm. Assign roles to team members on a cross-functional basis to help each member get an understanding of the organization as a whole. Assign roles, assign processes, assign maybe even technologies that can leverage how good they are at different technologies. It can be processes. So maybe a project first goes through the data, the SQL person or the Python person, who then standardizes it, cleans the data, and then sends it over to the Tableau person, who then visualizes it. I speak from personal experience. This is kind of what we do within data analytics at Bank of America. So, within our team, there are people that are good in Tableau, pretty much all of us are good at Excel, but sometimes the workflow is such that it goes through certain people first, certain people second or third, and some people fourth. And that's usually the most proficient and efficient way to work on said processes. Role assignment's important. And finally, make processes more efficient and standardized with each and every project. So that's the learning curve. That's kind of where the learning curve comes in, where the first time you work on a project, it's going to be slow. There's going to be a lot of problems. There's going to be communication errors. There may even be errors in the final report. But then over time, the more you do those kinds of things, the more time you spend on those kinds of projects, the time it takes to complete each project will go down little by little by little until it's kind of stuck at a certain level upon which it cannot, feasibly or realistically increase, or maybe it'll increase very, very, very incrementally. That's the level that you and your team want to reach at a certain point, because it saves the company time, money, and it saves you time as well. Doing the same things over and over again with as much automation and efficiency as possible. So market analysis, if you're looking to enter a strategic market, now what is a strategic market? I think generally speaking, I think it's all the wide array of strategies and tools that you can have in order to conjure decision-making ideas. And a large part of that is disaggregating market data and just analyzing market data. So market analysis involves disaggregating market data that's just all there. You have to find a way to clean it and extract only what you need in order to uncover pertinent trends and demands. That's basically what data analysis is. You just take a whole bunch of stuff that's just there, it's mumbo jumbo, you don't know what's there, and then you extract only what you need, you clean it a little bit, and then you're like, oh, okay, so this is increasing, this is decreasing, this is what we need to work on. That's essentially what it is. Most FP&A figures for strategic market analysis are, as I said, available in company financial statements within the SEC website, in a service known as Edgar, as well as their own companies. If you look up Coca-Cola financial statement, in the Coca-Cola website, in their investor relations page, you'll be able to find their 10K, their 10Q, other statements, even their statement of shareholders' equity, all that kind of stuff. And those three financial statements, it's really four if you add the stockholders' equity statement. They're all found within the 10K and the 10Q. And they have their own personalized statements as well. That's company specific. You can look into that as well, but that's more personalized. You can't really compare that kind of stuff with other firms. But these are the basic ones, the 10K and the 10Q. Deeper level analysis can be calculated or received through market research firms or research divisions of major companies. Like I said, this can be company specific as well. Usually you could find these on websites of Bloomberg, B of A, from my personal experience, Citigroup, Morgan Stanley, HSBC. I'm mainly listing banks here. There's only Bloomberg, which is not a bank, it's a tech company. But all these companies are some examples of companies that make their data public for everyone to view, because they're a public company. And finally, sharing of organizational knowledge and collaboration bolsters robust mechanisms for technical and financial analysis. And this creates market advantages, because the more in tune everyone in an organization is with its goals, everyone's on the same page, they know what their short and long-term goals are, they know what the objectives are in order to achieve their short and long-term goals and their mission. And that just, keeps the machine of an organization well-oiled. And that creates market advantages, as I said. I think there's much to add there as well. Okay, some basic stuff. You got to set actionable and clear goals for the organization in order for everyone to be on the same page, as I said before. screening and monitoring of goals through reporting, as well as feedback on how well those goals are proceeding, standardization, efficiency, automation in all of your work, automate any and all technical processes, scenario planning and forecasting, obviously the high level FP&A activities that are conducted on a daily basis, and aggregation and disaggregation of data using different points of view, and ideally having a cross-functional team that has a core understanding of some technologies where everyone's good at or familiar with, and then specialization of different technologies in order for the team to be diverse in their skill set and their knowledge, which can add to long-term security and long-term advantages for an organization to have a team like that. All right, now we'll get into some financial statement examples. This isn't going to take very long. I just want to visualize what these financial statements really look like. So this data I got from a case, but most of this company data is not accurate. This is just pretty much made up. But the trends are very much, they replicate what a company's income statement, statement of cash flows, and balance sheet, they look like generally. So over here, the very first thing at the top, you see net sales, also known as net credit sales, because you may not receive all your sales when the customer purchases them. Maybe a lot of them are buying it on credit, and you give them 30 days to pay it back. That's the 210 net 30 system that suppliers give to their customers. We'll go into that probably in future weeks. That's not super important to remember. So you can see it's growing, and then that's just the 1Q for 1996 for this company. That's why it's so much smaller than the previous years, but it's generally growing. Cost of goods sold is also growing. Now, cost of goods sold is basically your inventory plus whatever you sold. So it's usually your inventory is your raw materials, whatever is work in process, as well as your finished goods. And you can only sell your finished goods, obviously. Whatever's work in process or raw, you have to put on the balance sheet as inventory because you can't put that on your income statement. That didn't go into selling, essentially. Purchases are driven by cost of goods sold. So your COGS is going to be your beginning inventory that you purchased. Your beginning inventory that you already had, plus whatever new inventory you purchased, that's your cost of goods sold. You would subtract your ending inventory because you didn't sell it. So that goes back on the balance sheet. That has nothing to do with your income. So you'd subtract it. That's why they subtracted for 1993, 2539 and 337 in order to get 2202. Then the gross profit is just the net sales minus the total cost of goods sold. That's your gross profit. It's always sales minus COGS, 719. Operating expenses, 622. Now, operating expenses, this is usually where SG&A comes in. This is where the company needs to pay rent if they're renting out a facility or they're leasing out a facility. This is where payroll comes in, salaries and wages, and other forms of short-term payments that they need to pay instantly. That goes directly into operating. It ties directly back to a company's operations. So the business that they're involved in. If I'm creating shoes, operating expenses have to go into the workers that help create those shoes, the machines that help bind those shoes, and anything that is directly related to the creation of shoes from a shoe company. You subtract your operating expenses from your gross profit in order to get your EBIT, or your earnings before interest or taxes, because that hasn't been factored in yet. This doesn't get into amortization. That's a whole different thing. We don't have to worry about that. EBIT is $97. Now, notice how different that is from just the net sales because of how much we had to subtract because of COGS and operating expenses. Then the interest expenses for your debt, which is both short and long term, that's on the balance sheet. You subtract that as well, and you get 74. And then provision for income taxes, that is, we also don't have to worry about that as much. This doesn't exist for some companies. This provision exists for other companies. Usually it's subtracted, sometimes it is added. but it's more technical than anything that we're going to be delving into. And then your net income, that's your final line. You always see the double line here. Whenever it's single, it's usually calculating anything before the net income, such as COGS, sales occasionally, operating expenses, EBIT, EBITDA. Then not your EBITDA. That's the same as the net income. And then the net income is always going to be double line because it's going to be the last part of your income statement. Now, in your retained earnings statement, I just really quickly want to highlight this because it's not in the slides, but sometimes there's one extra line within the income statement, or they put it in the retained earnings statement where they have the net income. So for 1993, it's 60 bucks. They have another line that says dividends. So how much we're paying out in dividends. Let's say in this case, it's like 50. And then your retained earnings, which is net income minus dividends. That's 60 minus 50, and that's going to be $10 left for retained earnings. That's in a retained earnings statement. It's not in the income statement usually because it goes back to the balance sheet, but it does tie back to the income statement. So this is generally what the format of an income statement looks like. Usually the operating expenses are expanded to include every single line item of SG&A, but in this case, they didn't do that because they didn't need to. Balance sheet. So I said right hand and left hand side. Over here, it's more the top and the bottom. So this would be assets, or total assets. So this would be the right this would be the left hand side, sorry. And then this would be liabilities. Oh, sorry, not that. This entire part. And then your net worth is the only thing that they have as the stockholders' equity. So your net worth is basically your net worth. It's what it's the equity that you've put into this business. Or in the case of this business, it's the owner's net worth. And this stuff is the right-hand side of the balance sheet. So you have to manage the left-hand side using the right-hand side. Everything here, cash, accounts receivable, inventory, those are all current assets, so you add them up. And then PP&E, which is property, plant, equipment. You add all this up and you get total assets. And then the right-hand side is, how did we pay for this cash? Actually, not cash. Cash is just, it's the most liquid form of what you have. That's all yours. But usually, how did we pay for accounts receivable? How did we pay for inventory? How did we pay for the PP&E, the property, plant, and equipment stuff? Notes payable. This is notes payable to a certain bank for this case, but essentially this is the same thing. It's just a loan that you have. It's a short term. And this person's paying it off slowly but steadily in equal amounts to Holtz and increasingly to the bank. That's a strategy that many companies do based on the financial situation. Other notes payable, accounts payable is just, that's not exactly a loan. That's more of a short-term payment obligation. So if I bought inventory from a supplier, like raw materials, for example, I don't have to pay now. I can pay 30 days from now, but I haven't paid it yet. Therefore, it's an accounts payable. So I haven't paid it yet, but I have to pay it later, which is good because I have cash that I wouldn't otherwise have if I paid those suppliers off. So sometimes it's good to have accounts payable, and we'll see that later. Accrued expenses, more loans, notes payable, that's all your liabilities. And then your net worth, that can also include retained earnings and other stuff like that. That's for stockholders. Okay, get rid of that. And this, I believe, is the last slide for today. Yes. Statement of cash flows. So I think we did almost hit 7 o'clock anyway. But yeah, statement of cash flows, in my opinion, the most important one. And as you can see, net income is just a small part of statement of cash flows. It's important, but it's just one part of it. You add back net income because that's the cash that your customers gave. So that's a positive for your cash flows. It's all under operating, just these numbers. Because these are the expenses and the earnings that we got directly from our operations, from the stuff that we do. Like if you manufacture shoes, all of this has to do with manufacturing shoes and nothing else. So net income, we add that back. Depreciation, we also add back because that's more cash that we have access to that we were saved. Essentially, depreciation reduced the amount of taxes that we had to pay and reduce the overall value of our assets. So we have to pay out less. And as a result, it's a non-cash line item, but you can say it increased the amount of cash that you have on hand. That's why you increase depreciation. Increase in accounts receivable. If you have an increase in accounts receivable, that means you're not getting your cash now. Your customers are paying you later. That's why they're an AR. Hence you have to decrease that because you can't collect it yet. You will collect it later. So you have to subtract that from your cash flow. Now, hopefully this number is low because you want this to go into this as much as possible, or cash. Decrease in inventory. If you increase inventory, that means you're spending money to get inventory. That means your cash flow is going to go down because you're spending money. If you decrease your level of inventory, you're either selling your inventory off or you're selling it as finished goods, which then goes into your revenues and net income. And you're not buying new inventory. So whatever the net decrease is, you add that back because you're not spending any cash in order to buy that inventory. Increase in accounts payable. We like increases in accounts payable when it's controlled because that's essentially saying that I'm getting a good or a product or a service from a supplier right now, but I don't have to pay for it until later. So I'm gaining value without having to pay anything right now. So that's good. I have cash and I also have what I need, a good or service. And an increase in an accounts payable, obviously don't go overboard, otherwise your suppliers are going to be mad at you. But in the short run, it's actually good because we keep our cash while getting a service. Adding all those up, you get 2350. Investing, it's usually a negative cash flow because you're usually purchasing equipment or plants or properties or factories. That goes into investing. You're investing your money in order, like in those things, PP&E, for example, in order to maximize your returns in future years. So that's a short-term outflow of investment capital. So that's going to go in the parentheses because you're decreasing that. And finally is your financing. So once you pay debt, obviously you're paying it with cash, so it's going to decrease. That's why it's in parentheses. And owner distributions, in this case, can just be the disbursement of cash to the shareholders, for example. If you issue debt, that's actually an inflow, but that didn't happen here. So you also decrease that, that's minus 800. And then you do 2350 minus 400 minus 1100 in order to get the change in cash, which is 850. You add that back to your beginning cash that was there from last year, and you get ending cash. We didn't have access to these numbers over here, but let's just take it for granted. But this is the important number here. This means we had a net cash inflow, which is very good for the firm. Okay, that's going to be it. I'm going to stop sharing. Does anyone have any questions? I know that was a lot of information. The recording has been on the entire time, so you guys will get access to this recording after the meeting. And once again, if you have any questions after the meeting as well, you can send me an email. We'll also be sending out the quiz soon after. And I've finally figured out why I haven't been able to, let me start recording.